What if I told you the most dangerous moment for global markets isn't Monday morning, it's Sunday night? While you're relaxing, the financial system may already be breaking. Markets don't sleep, they wait. And this Sunday night, when Asian futures open, the calm you feel right now could vanish in minutes. This is what we're calling Black Sunday. Here's the truth most investors don't understand. The biggest market moves don't happen when Wall Street opens. They happen overnight, in Asia, in Europe, in thin, fragile liquidity. That's where crashes are born. If markets open sharply lower, there's no warning, no time to sell, no time to hedge. You wake up and the damage is already done. That's called a gap-down open, and it's how portfolios get erased. And this time, the risk is extreme. Why? Because liquidity is disappearing. For decades, foreign capital, especially from China, helped prop up U.S. assets. That support is fading, and when buyers step back, prices don't gently decline, they collapse. Modern markets are controlled by algorithms, not humans, and algorithms don't panic, they execute. When volatility spikes, they sell. When liquidity vanishes, they sell faster. There is no emotion, no mercy. That's why crashes feel sudden. It's not because everyone sells, it's because nobody buys. Sunday night is the most dangerous window of the week. Thin liquidity, high uncertainty, global tension. If futures break, circuit breakers may halt trading, but don't be fooled. A trading halt doesn't stop a crash. It confirms one. The calm right now is an illusion, because fear doesn't disappear over the weekend, it builds. And when markets reopen, it gets released all at once. But Black Sunday isn't driven by fear alone. It's driven by something far more dangerous. A global liquidity crisis that almost no one is talking about. Markets don't crash because of bad news. They crash when liquidity disappears. And right now, liquidity is vanishing. Liquidity is the oxygen of markets. No liquidity, no prices, no buyers, no floor. For years, the system relied on cheap money and foreign capital. That era is ending. As major holders of U.S. debt pull back, bond yields rise. And when yields rise too fast, something always breaks. This isn't opinion, it's math. Higher yields mean lower stock valuations. Every asset is repriced. Stocks, real estate, pensions. And leverage turns this into a disaster. Record amounts of stocks were bought with borrowed money. When prices fall, margin calls explode, sell, or be liquidated. That selling pushes prices lower, triggering even more margin calls. This is a liquidity death spiral. Pension funds aren't safe either. Many need steady returns just to survive. A sharp drop forces them to sell at the worst possible moment. Normally, central banks would intervene. But inflation has changed the game. They can't print endlessly without destroying currencies. The safety net is weaker than people realize. As stocks fall, fear spreads. People rush for cash. Banks don't have it. This is how market crashes turn into banking crises. And here's the key point most people miss. Money doesn't disappear in a crash. It moves. It flows out of fragile paper assets and into places that don't depend on trust. This isn't just a market event. It's a geopolitical realignment of capital. And when capital moves like this, it creates winners and losers. Next, we expose the wealth transfer happening right in front of you, and why most people don't even see it. Every market crash does one thing exceptionally well. It transfers wealth, and it never transfers it upward. For years, investors were trained to believe in one rule: buy the dip. It worked until it didn't. Now, when markets fall without rescue, psychology flips. Fear replaces confidence. Selling replaces buying. And here's where the system reveals its true nature. Large institutions hedge. They short, they wait with cash. Retail investors panic at the bottom. Trading halts don't protect you. They trap you. Margin calls don't warn you. They erase you. And when prices finally stabilize, guess who buys? The same players who caused the drop. This is why media silence matters. Warnings cause exits. Silence keeps retail investors trapped. History is clear. 1929, Monday. 1987, Monday, fear accumulates over the weekend, and then it detonates. Volatility is the accelerant. When volatility spikes, algorithmic funds are forced to sell, automatically. No emotion, no discretion, just execution. As markets fall, confidence collapses, spending slows, real estate freezes. The wealth effect reverses. This isn't just a crash, it's a reset. And while most assets bleed, some benefit from chaos, hard assets, scarce assets, assets outside political systems. This is where the illusion breaks. Markets don't exist to make everyone wealthy. They exist to extract wealth from the unprepared. So what happens after Black Sunday? What does the world look like when the illusion finally dies? That's the final piece. When the dust settles after a crash, one thing is always clear. The world never goes back to how it was. After Black Sunday, leadership collapses first. Overvalued sectors fall hardest. Concentration becomes weakness. Buybacks slow. Corporate support disappears. Prices fall until they reflect reality. And confidence, once broken, takes years to rebuild. A generation of investors learns the same lesson every cycle. Markets are not guarantees. They are risk machines. Capital flows shift. Trust in institutions weakens. In rare moments, both markets and currencies fall together. That's the danger zone. But crises also bring clarity. They expose weak systems. They punish leverage. They reward discipline. This isn't the end of the world. It's the end of a story people believed for too long. The story that risk was gone. The story that central banks could fix everything. Reality always returns. And those who survive aren't the loudest. They're the most prepared. Black Sunday isn't a prediction. It's a warning. And history shows exactly what happens when warnings are ignored.